Hello and welcome back to Road to Financial Freedom. Today, we're diving into a topic that every investor must consider: long-term versus short-term investments. Have you ever wondered whether you should focus on quick gains or play the long game with your investments? Or how to balance between short-term and long-term strategies to maximize your returns? If these questions pique your interest, then stay tuned. In this video, we'll explore the differences between long-term and short-term investments, their respective benefits and risks, and how to determine which strategy might be right for you. Before we get started, make sure to hit that subscribe button and ring the bell so you never miss out on our latest videos. If you're new here, welcome. Our channel is dedicated to helping you achieve financial freedom through insightful tips and strategies. Stick around until the end of this video because understanding the right investment strategy can be a game changer for your financial future. Let's start by defining what we mean by long-term and short-term investments. Long-term investments. These are assets that you plan to hold for several years or even decades. Common examples include stocks, bonds, real estate, and retirement accounts. The goal of long-term investing is to build wealth gradually over time through capital appreciation, dividends, and interest. Short-term investments. These are assets that you plan to hold for a few months to a few years, often less than 5 years. Examples include savings accounts, money market funds, short-term bonds, and stocks you intend to sell quickly. The goal of short-term investing is to take advantage of market fluctuations to make quick profits or to preserve capital for near-future needs. Now, let's delve into the benefits and risks of long-term investments. Benefits: compound growth. One of the biggest advantages of long-term investing is the power of compounding. The returns you earn on your investments generate their own returns over time, leading to exponential growth. Reduced volatility. Long-term investments are generally less susceptible to short-term market fluctuations. By holding investments for a longer period, you can ride out market downturns and benefit from the overall upward trend of the market. Tax advantages. Long-term investments often come with tax benefits. For example, long-term capital gains are typically taxed at a lower rate than short-term gains, and retirement accounts like 401ks and IRAs offer tax-deferred or tax-free growth. Lower transaction costs. Long-term investing involves fewer trades, which means lower transaction costs and fees. This can significantly boost your overall returns over time. Risks. Market risk. While long-term investments can weather short-term volatility, they are still subject to market risk. Economic downturns, changes in interest rates, and other macroeconomic factors can impact long-term returns. Liquidity risk. Long-term investments, such as real estate or certain retirement accounts, may be less liquid. This means you might not be able to access your money quickly if you need it. Inflation risk. Inflation can erode the purchasing power of your money over time. It's important to choose long-term investments that can outpace inflation to preserve your wealth. Next, let's explore the benefits and risks of short-term investments. Benefits. Liquidity. Short-term investments are typically more liquid, meaning you can easily convert them into cash if needed. This makes them ideal for emergency funds or saving for specific short-term goals. Lower risk. Short-term investments are generally considered less risky because they are less exposed to market volatility. This makes them suitable for risk-averse investors or those nearing retirement. Flexibility. Short-term investments allow for greater flexibility in adjusting your portfolio. You can quickly respond to changes in the market or your financial situation. Risks. Lower returns. Short-term investments typically offer lower returns compared to long-term investments. This is because they are less exposed to the growth potential of the market. Tax implications. Short-term capital gains are taxed at a higher rate than long-term gains. Frequent trading can also lead to higher transaction costs and taxes. Opportunity cost. By focusing on short-term investments, you might miss out on the higher returns that long-term investments can offer. This is the opportunity cost of playing it safe. Choosing between long-term and short-term investments depends on several factors, including your financial goals, risk tolerance, and investment horizon. Here's how to determine which strategy might be right for you. Define your financial goals. Are you saving for retirement, a down payment on a house, or an upcoming vacation? Your financial goals will help determine whether long-term or short-term investments are more appropriate. Assess your risk tolerance. How comfortable are you with market volatility and potential losses? If you have a higher risk tolerance, long-term investments might be more suitable. If you prefer stability, short-term investments might be better. Consider your investment horizon. How long can you afford to leave your money invested? If you don't need the money for several years or decades, long-term investments can offer better growth potential. If you need the money sooner, short-term investments might be safer. Diversify your portfolio. A balanced portfolio includes both long-term and short-term investments. This diversification can help manage risk and ensure you have liquidity when needed while still benefiting from long-term growth. Let's look at some real-life examples to better understand how long-term and short-term investments work. Long-term investment example. Imagine you invest $10,000 in a diversified stock portfolio with an average annual return of 7%. Over 30 years, thanks to the power of compounding, your investment could grow to approximately $76,123. This growth is achieved by reinvesting dividends and capital gains, allowing your money to grow exponentially over time. Short-term investment example. Suppose you have $10,000 that you want to keep safe and accessible for a home down payment in 2 years. You might choose to invest in a high-yield savings account or a short-term bond fund. While the returns are lower, around 1 to 2% per year, your money remains liquid and relatively safe from market volatility. A balanced investment strategy often includes a mix of long-term and short-term investments. Here's how to strike the right balance. Emergency fund. Keep a portion of your savings in short-term liquid investments for emergencies. This ensures you have access to cash when you need it without disrupting your long-term investment strategy. Investment allocation. Allocate a percentage of your portfolio to long-term investments for growth and another portion to short-term investments for stability and liquidity. Adjust this allocation based on your financial goals and risk tolerance. Regularly review your investment portfolio and adjust your allocation as needed. Life events, changes in financial goals, and market conditions can all impact your investment strategy. Stay informed. Keep yourself informed about market trends and economic conditions. This knowledge can help you make informed decisions about when to shift between long-term and short-term investments. In conclusion, both long-term and short-term investments have their unique benefits and risks. The right strategy for you depends on your financial goals, risk tolerance, and investment horizon. By understanding the differences and carefully considering your own situation, you can create a balanced portfolio that meets your needs. If you found this video helpful, make sure to give it a thumbs up and subscribe to Road to Financial Freedom. We've got plenty more content designed to help you navigate the complex world of finance and investing. Be sure to check out our other videos for more tips and strategies on making smart money choices. Thanks for watching, and we'll see you in the next video.